Welcome, podcast listeners, to another episode of the Chart Book. I'm actually based in my mom's basement right now in Colorado. Very millennial of me, but this beautiful background is actually a photo I took. Last week, we were in the Flat Tops Wilderness with my family, riding horses, catching some trout, taking a 3-day digital detox, which I highly recommend in these crazy times. But figured we'd catch up in markets. We haven't done one of these in a while, so with the way that things have been a little crazy, as they always are with markets, thought we would get started and chat a bit. So let's hop on over to Twitter as a good jumping off point. We had a good tweet around the 4th of July where we talked about happy 4th of July to everyone, talking about financial freedom, not just political or religious or all the other freedoms we enjoy as U.S. citizens, but thinking about, some of the challenges of the income and wealth gap in the United States. And this is a focus of another article I have coming up soon, but I want to talk about, if you are serious about building wealth, there's really 3 main ways to think about it. And here's how I laid out the narrative. The first is own the business, being an equity owner instead of an employee, being the bank, namely earning interest instead of paying it, think credit cards. And lastly, holding the keys, being the landlord instead of the tenant. And the whole point of this wasn't that you actually had to go do these 3, but rather a lot of people think these concepts are unattainable, when in reality, most of these can be accomplished through public markets today. And the concept is over 2,000 years old. We talk about it. It's kind of the Talmud portfolio in our book. And, the simple takeaway is even at 10% returns, which doesn't seem like a lot, over time compounds. So you 10x your money in 25 years and 100x it in 50. And most of us aren't really willing to get rich that slowly, but the actual allocation doesn't matter that much. And talking about allocations, there was a great recent update from the Yale endowment, which tends to have one of the weirdest allocations out there, at least not very consensus and a little contrarian in the way most people think about it, but they actually have less than 10% in U.S. domestic stocks and bonds. And almost no other institution or person probably has that allocation in the country. And to be fair, a lot of their allocations, whether it's absolute returns, particularly private equity, venture capital, and they call it private equity leverage buyouts, have a very strong beta to U.S. stocks. But in general, a very different allocation. And then if you look at even some of the most famous hedge funds in the world, and this was from Jake at Econompic, he's going to show that a very simple 60-40 portfolio, which is the blue line, compared to the world's largest hedge fund, Bridgewater, they have 2 big portfolios. I like to say that you can always tell if a journalist or commentator guru is trying to be honest commenting about Bridgewater, because they have 2 different funds. The one style is all weather, which is nothing more than a buy and hold risk parity type of allocation, doesn't really do much. And then Pure Alpha, which is more of the traditional hedge fund, multi-strategy fund. They zig and zag at different times. They're struggling this year. But in general, Jake's point was that you end up at the same place if you put 50-50 in each of those. And I forget what Bridgewater calls it. It's something like the ideal portfolio or something like that. But you end up roughly at the same place as 60-40. Now, part of that is due to the outstanding decade that 60-40 has. And if you look at all 3 of the different strategies right here, they have all end up in the same place, which is a bit remarkable. Again, going back to my original point, asset allocation, these assets over short periods go all over the place. And this is a chart of year to date. It shows on one end, you have gold up 25% this year, hitting all-time highs right around 2,000 for the gold bugs out there. Pat yourself on the back. Congrats. It's still not something that's showing up on a lot of people's radar. A lot of the momentum and trend followers certainly are long. And then all the way down on this portfolio, year to date, U.S. bonds still having a great year, up 10% for the 10-year. U.S. stocks now positive on the year, close to all-time highs. And then the rest of the characters still down from the coronavirus meltdown. So you have emerging markets, developed markets, real estate, and then energy-based commodities bringing up the rear. But then if you tease out the even within the U.S., roughly flat on the year, this is Alpha Architect funds. I think they do the best job of giving a pure exposure to value and momentum within the U.S. market. Disclosure, we own all of these funds. On one hand, you have the quantitative momentum in the U.S., is absolutely crushing it, not surprisingly, followed up by Momentum International. And then I'm sorry to show this for the value crew out there that's been struggling, both international and bringing up the rear being US value. But what looks like massive spreads, in this case, just for stocks, 35 percentage points in less than a year. And the same thing for asset classes, 45 percentage points. But over time and on average, as long as you have some of these main ingredients, and we show this in our global asset allocation book, you can download it for free, Cambria Investments. It doesn't really matter what the exact mix is, as long as you have some global stocks, some global bonds, some global real assets like commodities, tips, and real estate, you end up in a good place. That having been said, I do think that there are ways you can improve upon that basic global market portfolio. And that's like kind of looking around, see what's going on in the world. On one hand, we have old school, one of my favorite technicians, Helene, talking about Tesla. And this is fun. I mean, who else does this on by hand anymore? But here's a chart to where Tesla is going so parabolic, she has to tape on an additional chart. And you have some of this craziness, bananas going on. And even though people seem to love to always compare this to the 90s, which was my favorite bubble that I grew up in as a high school and college student. For context, if you look at the market cap weighted market, just the S&P 500, we're at a long-term PE ratio, 10-year P ratio, CAPE ratio of around 30. And that's expensive, and that means we expect low single-digit returns going forward. But to be fair, the U.S. has hit 45 before in the 90s. And if things got as crazy as they did then, we still got 50% till we get there. Think about that. If the market went up 50% from here, how much people would lose their minds. But that's not even the upper bound, right? Markets can always go higher than they have in the past. So in the late 90s, that's higher than they've ever been. But if you look at other countries, Japan hit almost 100 from the highest 10-year P ratio in the 80s. So that's a straight up triple from here. Can you imagine markets tripling from here? I think that would be really hard for many to imagine. But again, going back on trying to be reasonable and being a bettor, does it make sense to try to bet on markets to go up to the highest they've ever been or the highest equity market ever with Japan? It's not a particularly reasonable bet. And to tease out some of the high market cap names, this is Will Hershey talking about the 20 largest companies. This was in the world. He was talking about traded a big time estimated PEs around 30. And then he looks at price to sales and shows that it's around 7. So companies getting to be pretty darn expensive at the top of the market cap weighting. But that goes back to market cap weighting's biggest problem anyway, which is it's agnostic to price. There is no fundamental anchor when it comes to market cap weighting. It's just price times shares outstanding, has no tether to what's going on with real fundamentals. So here's a great quote from Jesse Felder where he's talking about Scott McNealy during the 90s bubble when Sun Microsystems, and I'll just read it out to you, but he was talking about the craziness with his stock. And he said at 10 times revenue, which is what it was trading at, to give you a 10-year payback, I have to pay you 100% of revenues for 10 straight years in dividends. That assumes I can get by my shareholders. It also assumes I have zero cost of goods sold, which, by the way, is very hard for a computer company. That assumes zero expenses, which is really hard with 39,000 employees. That assumes I pay no taxes, which is really hard. That also assumes you pay no taxes on your dividend, which is kind of illegal. And that assumes zero R&D for the next 10 years. I can maintain the current revenue run rate. Now, having done that, would any of you like to buy my stock at $64? Do you realize how ridiculous those basic assumptions are? You don't need any transparency. You don't need any footnotes. What were you thinking? And Jesse goes to show that, this stock did a straight up round trip from 5 to 65 back to 5 in the course of a couple years, true bubble territory. And you always have to distinguish, by the way, between a good company, a good business, and the concept of a good stock or a cheap stock. So as you look around, this is the largest U.S. companies by market cap. You got to remember that market cap right now, Apple, Microsoft, Amazon, Google, Facebook, everyone uses those. Those are household names. But go back to, after I was born, it was a child of the 80s. Look at 1980. 0 of those companies are still in the top 10 today. I mean, that's astonishing. And I'm trying to see if any from 1990. I don't think any from 1990 are. Only once you get to 2000 do you start to have a couple of the companies that have made it 20 years. So a lot of these top names don't make it that long. They don't stay in the top rung. Now think about why that is. It's capitalism. It makes sense. By the time you get to be there, you have a target on your back, but that's the way that it should be. It's hard to maintain those levels of profitability. There's a great white paper by Rob Arnott and research affiliates called The Winner's Curse, Too Big to Succeed. And they've done some good posts on this topic where, and here's a visualization of it. It's from Abnormal Returns, but Dimensional, where they show that, the biggest stocks underperform the market over the next 10 years. And this shows that after becoming one of the 10 largest stocks, it underperforms by 1.5% per year. But Research Affiliates has done this with the single largest stock. They call it the top dogs. They've done it within sectors and within countries. And on average, it averages out to be about 3 percentage points per year for the next decade. So one of the simplest ways you can outperform is just get rid of the biggest stuff. And that's why a lot of the other ways of weighting, whether it's equal weighting, fundamental weighting, or doing something like valuation, which we prefer, or even momentum. As long as you break that market cap link, you end up adding a couple percentage points of performance over time and on average. Now, the problem with the U.S. right now, this is from our friend David Taggart at PD Macro. He showed there's another series we love called the Value Line Median PE. This goes back to the 70s, and it recently just hit the highest level it's ever hit. So you can see that it's not just a market cap phenomenon anymore. But by the way, look, notice this got pretty darn cheap, got down to 10 during the financial crisis and then in March. So you've had a massive rubber band, cheap than expensive again. But it's showing that it's not just a market cap problem, it's a median problem as well. You guys know my shtick. I've been saying for a while, one of these days I'll be right, that global valuations are a lot cheaper. This is from Danielle DiMartino Booth, where she talks about, hey, at financial crisis time, a lot of other countries were cheaper, emerging markets in particular. And she's talking about, in this case, it's Korea, Malaysia, Poland, Turkey. We're all more expensive than U.S. stocks. But fast forward a decade of really strong U.S. returns, and you have a situation where many of those countries are 50% or less. One of the biggest reasons you need to think about breadth, the U.S. is only about half world market cap, and that's agnostic of the valuation. With GDP, it's only around a quarter, and valuations, you could end up having more. But a lot of people in the U.S. put 80% of their money in U.S. stocks, and that's such a silly idea. And Peter Mallouk from Creative Planning demonstrates this with this beautiful chart that shows over the years that one of the reasons you consider a global portfolio is most of the big companies, even if you looked at it as big companies, billion-dollar companies, are outside the U.S. So just from a simple quantitative breadth standpoint, it's very foolish to constrain your universe to just a subset of companies. So here's another variation in the chart we looked at earlier, which is largest companies by market cap by decade globally. And you can see in 2020, it's almost all U.S. There's a couple Chinese companies sprinkled in. But if you go back over time, it's not always the case. 2010 is actually pretty balanced. You had all sorts of different flags in there. 1990, look at that. Japanese Empire of Japan almost universally dominated the chart. And so over time, look, this isn't an exact contrarian indicator, but it is, I think, pretty helpful demonstration to show just how far things have moved. And my pinned tweet, if you haven't seen it and you go to it, shows the top 6 resources about international versus U.S. investing, demonstrates a lot of these ideas that it's pretty rare for the U.S. to outperform market cap or equal weight version of countries. It only happened a few decades over the past 130 plus years, and one of those was the most recent. This is all exciting, fun, sexy stuff. I think it's sexy. I'm a quant nerd. But one of the things I think is particularly useful, that if you notice this tweet from today got very little love, mainly because it's talking about taxes, but is arguably more important than everything we've talked about already, which is the implementation of how you go about this. So let's say you can match U.S. stock returns, call it S&P 500, in any possible structure. And you want to go implement this. And this is the boring, basic blocking and tackling, but arguably, in my opinion, more important than fees, probably more important than trying this elusive search for outperformance. So I tried to rank structures as to the best way, if you could do it, if you're a high net worth investor in the United States, high taxable account. This isn't tax exempt. This isn't retirement. This is purely taxable accounts. That structure matters. And I listed them from probably best to worst. This assumes you can match the S&P. The first is investing in private companies with a 50 million and below market cap. And this is largely because you'll pay no income. They don't pay dividends. And because of the QSBS rules, qualified small business stock rules, you end up not paying any capital gains if you hold those stocks for 5 years on either the first 10 million in gains or 10x returns on those stocks. I mean, that's just astonishing. So theoretically, if you could build a portfolio of small private companies that match US stocks, if they outperform, that's gravy. You would end up paying no capital gains and no income. Okay, now this is hard to do. We'll talk more about this in a minute, but let's get to the public versions. An ETF, as we know, either index or active, it doesn't matter. It's not going to pay any capital gains until you sell it. So it's a capital gains deferral for as long as you hold it. If you hold it a year, if you hold it 50 years, you likely won't pay any capital gains. So if you have an ETF that did this approach with no dividends, there's not really any out there that do it. We filed for some. We wrote a paper about it we can talk about. Is a pretty cool way to express that. But an ETF with dividends is still better than the other things that come after it. Direct ownership. So if you own stocks in your own account, you can specifically manage them as you see fit. The same thing with a robo-advisor tries to do this. I think those are reasonable if they're doing direct, they're owning stocks for you. Problem is for most of these high net worth investors, you can only, roll forward $3,000 in losses. For most people that are in high net worth brackets, that's not that big of a deal. But it's still good. I think it's totally reasonable approach if you like that. The problem is often they'll generate these like gazillion transactions. And if you hate tax complexity, you may not like this. And on top of that, I'm not going to mention who, but even some of these automated services that have implemented this have got fined by the SEC for implementing it improperly, because it's still pretty tough to do. Even then you still have the income. You're not avoiding the dividends as well. Last are either the hedge fund or mutual fund structure. Those offer no benefits when it comes to the capital gains deferral. You're going to be paying on, particularly if you have a high turnover strategy. Index is better, but if you have a high turnover strategy, you're going to be paying capital gains each year, and some of those are pretty bad. On top of that, you may have capital gains exposure from investors that came before you. So a really inefficient structure. Plus, if you have money coming in and out, the portfolio manager has to buy and sell. So use this as a note card. Again, this is my belief, but I think this probably actually swamps the importance of what you actually invest in if you're a stock investor and you're taxable. Okay, for those who haven't fallen asleep, by the way, you can go read this old paper. This actually goes to say that if you're going to do, the last thing you ever want in a taxable account is high dividends. It's a horrible idea. You actually want to avoid dividends altogether. And if you're going to do a dividend style approach, which is nothing more than a not particularly good way of expressing value, just do value. And then you can, on top of that, avoid high dividenders. Not a lot in the academic literature that's ever addressed this before or after this paper. If you've seen some, shoot it over to me. And this is called Do You Pay Taxes, Then Avoid Dividends, Do This Instead. It's on the website. You can download it for free. Let me know what you think. All right, next, where are we? So, for those who have been around long enough, we talk a lot about going back to the structure of investing in private companies on the podcast and on the blog over the years. I started doing this, I think, 6 years ago, and have been very honest about the approach. And my approach has been to, from the get-go, is look, I'm going to go slow, invest low dollar amounts, and try to build a portfolio over the years that can take advantage of this QSBS, but also that I think it's very optimistic. I want to learn a lot, not just about private investing and startup companies. And I tend to focus on sort of seed and Series A, maybe very rarely Series B or later, but that's only if it's a company I really love. We talked about it on the podcast for the late stage, like Lyft or Hotel Tonight or Impossible Foods. And we talked a lot about the resources, AngelList, Equity Zen, WeFunder to a lesser extent, but really AngelList being the main one. And then direct with friends, and you start to build a network. So it's been an incredible learning opportunity. And I said in the beginning, if I zero out and I make no money, I'm okay with it. I mean, I wouldn't be, I'd be bummed, but going into it, I expected that. But I also expect to say, look, I'm going to make 20, 50, 100 bets. And then as those bets start to mature, you kind of plant the seeds. Some go out of business, some succeed. A great introductory book on this is Angel by Jason Calacanis. We've had 2, 3, 4, 5 famous angel investors who've been doing this for a very long time on the podcast. Fabrice Grinda, we've had Phil Nadell, all sorts of ones you can go listen to. But I thought this was, I said my goal is to eventually, I'm close to passing 200 private companies. And my goal is to get over 500 by the end of the decade. And, some of these have, at least on paper, gone up 5, 10, 50. There's one that's close up to 100 bagger, which I've never had in public markets. And then as far as cash on cash returns, I think the largest has been about a 16 bagger. And that company's been on the podcast. You can probably guess who it is. The founders. We've been doing a lot of founder series on the podcast, but looking back on it, there's also a very real element of luck. If I were to grade all my investments at the time, I wish I had done this. I don't know that the ones that I would have graded most confident would have been the rocket ships, and the ones that went to zero, I would have had any less confidence in. But Dave McClure has a nice thread. I'll let you guys go and read this. But to summarize, he's like, look, I've been doing this for 20 years, seen thousands of decks, invested in hundreds, but it's still humbling how often I'm wrong. And he talks about how, let's see, there's a good quote. He says there's not a whole lot of correlation between his conviction at the time and end result. And so the lessons he takes from thousands of deals over the past 20 years, the important is the more swings I take, the more shots I make, the more likely I hit a home run or score a goal. It's not some great mystery or even much practice craft. It's just gradual and quantitative. And this is really important. And I think a lot of people that do angel investing or stock investing make the mistake of not making enough investments. And almost all the academic literature shows that not just on private investments, this applies to public investments too. So we've linked to a lot of public investment research on the blog and Twitter, JP Morgan, Longboard's capitalism distribution, and there's a bunch from, I think it's Best Bender. We'll put it in the show notes, but links to papers about public market investing that shows this distribution of returns, that even if you invest in the S&P 500 or any index, the reason it works is you have these massive outliers, the McDonald's, the Walmarts, the IBMs, the Googles, the Facebooks, that return 10, 100, 1,000 times your money. Most stocks on average don't make any money, and probably, let's call it a quarter or a third, end up losing all their money. I think it's about 2/3 underperform the index. So you have to own the big outliers. And so one way to do that is an index through market cap weighting or equal weighting, but you need to own probably at least 50 stocks or private investments to really have the chances of hitting the big ones. Honestly, it's probably 100. And so Jamie Catherwood has a great chart from a book, a VC book that talks about whaling and VC firm returns. And they're pretty simple. But this, if you were to overlay public stocks, it would be very similar, which is the big outliers are rare, but they end up generating most of the return. There's another article by David Coates that shows the same thing. Excuse me. Where is it? There it goes. And shows the distribution of realized venture outcomes over the past decade. And again, these massive big winners, were very few, but they really generated so much of the return. Anyway, I think as this becomes more well known, a lot more interest has gone into venture capital. It's still tiny compared to public markets, even if you look at a lot of these massive funds, even SoftBank, compared to public markets. And most of those guys weighed in at the bigger company levels. So, the $500 million companies and bigger. So when you talk about private equity, it really means two things. Private equity being leveraged buyouts, which are the monster billion, $10 billion companies plus, like Dell and things like that. And then venture capital. And then even venture capital, you go from seed all the way to series A, B, C, D, E, F, G, H, I. And I think the sweet spot, at least for an individual, is that sort of series A, seed, maybe series B. But you've seen a lot of companies, big ones like Vanguard, start to move down the market cap ranks. Vanguard just launched, I don't know if they've launched it yet, but is talking about it, a private equity fund, which I said 2020, nothing will surprise me. DFA has been launching ETFs. Who knows what's gonna happen with this year? But it's pushed a lot of the valuations of private equity companies, particularly in the LBO range, up to be pretty high. One of the benefits of the smaller Series A and seed is if you're investing in a $10 million valuation, it's a lot easier to go from $10 million to $1 billion than it is from, 100 billion or even 10 billion up to 100 or a trillion. Anyway, let's talk some quick hits. We'll wind this down. There's some interesting stuff going on. I happen to be a huge fan of income sharing agreements. A lot of people, it triggers their brain for some unknown reason. But I think it's a really interesting innovation that's going to have legs. There are two great podcasts on it about it this week. Animal Spirits with Batnick and Carlson talked about it with a company called Edley. And then there's also one by Rebank that covered it. But Lambda School is still being the most famous. And I tweeted last month, I think this is a really good idea. I wish someone would do it. But I said, I wonder why someone wouldn't do this for financial planners. As we know, there's not a lot of young financial planners out there. They're going to be taking over these older books. And if I had to think of, in particular, a future-proof career, I think the automated services will only enable these financial planners. I think financial planning is one of them. And so I said, you don't even have to be a public company like Lambda to be focusing on financial planners. You could be someone like a big RIA like Hightower. You could be a designation like CFA or even the certified financial planner. Why wouldn't you do this? The cost to get the financial planning designation is only like $5,000. And you could come up with a whole internship program. There was actually pretty cool news today where Schwab announced a $30 million charity program where they were doing it in the financial sort of planning focused on undergraduates, African Americans in the US. Anyway, I think there's a lot more development there that I would love to invest in. I haven't done anything there yet, but would like to. A couple more quick hits. This says I'm an independent, but it's interesting to note that the betting markets are now favoring Democratic control of the House, Senate, and presidency. Take that for whatever you wish. But my favorite indicator that's starting right now till the election, that's 85% accuracy in predicting the presidential election is the stock market up over this period. So if you're a Republican, you better put your money to work. You better cheer for market to be up. If you're a Democrat, you want it to be down. But it has an astonishing accuracy with predicting if the party in power stays in power. This coronavirus has created a lot of carnage this year. One of the sad ones, Chuck E. Cheese filed for bankruptcy, which is odd that there hasn't been a higher food quality version of Chuck E. Cheese. Maybe there is. I don't really consider Dave and Buster's, but one of my favorite random stats of all time is the founder of Chuck E. Cheese also started Atari. How cool of a life has that guy had? Here's another great tweet from Wes. We already mentioned Alpha Architect earlier, but I get this question every single day on email. So I'm glad to have a place to send you guys where it's talking about how to start an ETF. And Wes and company has helped some other entrepreneurs start their own. They have this white labeling service where if you want to start an ETF, you can go and get on their trust and they'll help you. But he also walks through the whole process. You want to do it on your own, you want to start your own company, all that jazz. Go check it out. We have a really old post called something like how to start an ETF. You can Google and find. Wes does a better, more modern job of it. By the way, if you're doing the local March for the Fallen in Los Angeles, hit us up. Corey, I think, is in charge of it. It's going to be a lot of fun. Local company to Colorado, Personal Capital, just got bought, $1 billion. Congrats to those guys. That was one of the early kind of big three of the robo-advisors, Betterment, Wealthfront, Personal. And they took a different tact. They were always much higher fee, up around 80 basis points. Came with a financial advisor. One of the best things they did and still do is that they have this aggregator that lets you aggregate assets for free. They used it as lead gen, of course, but you never had to work with them. I still get calls probably once a week from those guys. But a beautiful way. It's kind of like the modern Mint. A number of sites do that now, but it's still a good way to get a holistic view of all your assets, whether you work with them or not. This is wonky for all the people out there. The US dollar is starting to roll over. People, I think, really struggle with currencies. And my friend, Dan Ferris, was asking about it. And I had actually written a book on currencies many years ago, never published it. I think it's just too confusing for most people. Maybe I will. But he was asking about reads for currencies. And so you can go scroll through this thread. Triumph the Optimist is a great one. I don't think a lot of people understand, but in general, real exchange rates are stable over time. They adjust for inflation. It's called purchasing power parity. Now, it doesn't mean they can't be up 10, 20, 30% a year or down, but in general, they equalize for inflation over time. But there's a lot of good books. And, I said for the investors that don't know, a shekel from a won, rupee from a cable, a dollar from a dinar, or Why Gresham Has a Law. Here's some of the good books. Foreign Exchange by actually Mark Mobius. Try to get Mark on the podcast. See if anybody knows him. Tell me to come join. Money is a great visual book of the history of money. Empire of Wealth from John Steele Gordon, great author. A Sin of Money, that's also got a video version. Paper Promises, and the actual mechanics of it. A Foreign Exchange Primer by Shema, and one of the best ones, Tim Wyther's A Practical Guide to FX Markets. He's got a great quote where he says something along the lines of, currencies aren't difficult, they're just confusing, particularly for Americans. And then last one by Nadig and crew, Currency, the Overlooked Asset Class. Anyway, some fun reads in there. In Currencies, my general takeaway is if you're doing equities, I'm agnostic if you hedge or not. I don't think people should be trying to dart in and out, but you can apply very simple approaches like value, trend and momentum, and yield curve and interest rates, which is sort of what we do with one of our strategies and funds, going back to talking about sovereign bonds, which is a value approach, which is investing in carry, the highest yielding markets, which is interesting right now because a huge portion of sovereign bonds are negative yielding, which is crazy why you would invest in those. I think a lot of people, it's a little weird to be investing in bonds that pay you -1%, 2%. So having a tilt towards yield, at least historically, has offered a higher return. Oddly enough, the U.S. has been in that bucket. It's like the U.S. and a bunch of emerging markets, not so much because U.S. has a lot of yield, but more just because the rest of the world doesn't. Here's a nice post from Christine Benz, which again goes back to the practical nature of estate planning. She said, look, working with my parents the last few years, I was struck by the fact there are few items that would have been helpful to have, but are often unaddressed by estate plans. And many people don't even have them. So this is sort of just a reminder to get your act together, not tomorrow, not next week, not next year, but click on this. She gives you a good overview of how to put together a good plan. Lastly, for those who are in coronavirus and have just a lot of time on your hands, oddly, I've read like no books. I feel like busier than ever. But for those who are looking for some distractions, Patrick has a bunch of great resources where he asked about compilations. Asked everyone for their best essay, business essay, best explainer videos. So he's got a compilation of those. I got a whole bookshelf at home from Patrick book recommendations that I still haven't got to. It's going to last me many years and decades. We actually did something similar with, you guys know that I do like a podcast of the week each week. So we did this on the Idea Farm, and then we just decided to share it because everyone's kind of bumming during Corona. This has been tough for a lot of people's mental health. So we said we put together Spotify playlists of the best curated podcasts focused on investing. Particularly, I said, if you're also doing a gap year, not going to college, or skipping an MBA, this is for you. It's over 300 hours worth on Spotify, 2017, 2018, 2019, 2020 so far of the best investing podcasts. It's like getting a master's in investing, but for free. Anyway, enjoy. Let me know what you think and hit me up. Lastly, I'm going to take you out on a beautiful sounds. This is from our farm in Kansas. Kind of creepy, right? But beautiful. See if you can get any thunder sounds on this. Maybe not. But anyway, a beautiful, haunting view from the fountain. I didn't get to see the comet, by the way. I know my brother did. Anyway, guys, this has been fun. If you have any suggestions for us on this chart book episodes, let us know. Shoot us feedback at themebfabershow.com. We'll start doing the radio shows again on the podcast. And as we traverse the country back to Los Angeles, hopefully we'll record a few more of these. So send in some charts. We love to include them from readers as well. Thanks for listening, friends, and good investing.